let's look at the U.S. economy. The modest growth we saw in the first quarter is going to be really challenged for the remainder of the year. We call it the double whammy, and that is tight monetary policy, which typically acts on a lag. Now combine that with tighter lending conditions because of the banking crisis in the beginning of this year. We're seeing tight monetary policy filter into many areas of the economy. Manufacturing's been in contraction territory now for 5 consecutive months. Housing continues to be impacted, and we just saw existing home sales decline on a year-over-year basis for the first time since 2012. Consumers have often been something we've been concerned about, and we're finally seeing cracks in that multi-year spending spree. Consumer spending is slowing, and they're still relying on credit card debt with record high interest rates. So as a result, we're seeing not only credit card delinquencies rise, as you can see in this chart, but also auto loan delinquencies rise. From a business perspective, we're seeing spending being pulled back from businesses because of the uncertain economic outlook, and we're now starting to hear layoffs be announced as well. The last concern is from the banking crisis and what that means for economic growth. It's very difficult to quantify how much a tighter lending conditions can do to the economy, but we do know it will have a negative impact, especially for small and mid-cap companies that rely on these small regional and mid-cap banks for loans. Commercial real estate also continues to be a concern, not only because they also rely on small and mid-cap banks for loans, but we're talking about a lot of commercial real estate loans maturing in 2023, 24, and 25. All of these things are what we consider the negative effects that we think for the rest of this year from an economic standpoint. And we do think that a recession is likely at some point. But we also have to remember that recessions are healthy. We need to work out a lot of these excesses in the economy because there's no way that we can get inflation under control and have long-term stability in the economy unless we do. The other positive to hold on to with all this is that the labor market still remains very strong. We don't deny that we'll see a rise in the unemployment rate, but with the labor market historically strong the way that it is, it should help us emerge from this recession. It should help the recession not be long and prolonged, but most likely be a short and shallow, just a necessity in order to clear out excesses for the long-term viability of the economy.